We are very lucky to have here today two experts on clean technology, the business side, which I think is appropriate because we're in New York, to talk about this opportunity. We are currently in a situation which is almost unprecedented in American history of record-setting oil prices. Today, prices went up to about $113 a barrel. So we're ushering in a new period of really severe shortages in terms of commodities, including oil, which is probably going to change a lot of things in our economy, and we're only just starting to see the beginning of it. So we're very lucky again to have our two panelists. Let me say a few words about them, and I'll introduce them as each person gets up to give their presentation. Peter Fusaro is the head of Global Change Associates. Peter gives the annual Wall Street Green Trends event here. His most recent one was just a couple weeks ago. He's also the best-selling author of What Went Wrong at Enron, and I think we're going to hear from him today some very detailed information about the policy environment for clean technology as well as specific investment trends which are going to be shaping the sector. We're also lucky to have David Kurzman, who is with Panel Intelligence. David has a long career in terms of analyzing trends in the clean technology and energy sector. Panel Intelligence itself is a very interesting company which employs kind of expert networks to provide detailed information to people, participants in the sector. And David's going to drill down even further and talk at length about some of the clean technology trends. So what I'd like to do is kind of set the stage a little bit. As I mentioned, oil prices are at all-time highs. We, of course, are aware of the climate change situation, which is changing everything about kind of what the constraints in which the economy operates. So these are unprecedented times, and they pose great new challenges. But at the same time, challenges pose opportunities, and clean technology has the potential to become one of the really important industries of the next 100 years. One thing about the energy sector, and clean technology in particular, is that it's such a large portion of the economy. So the changes that take place in terms of replacing fossil fuels, making the economy cleaner, are going to have an immense effect, possibly even bigger than things like the internet, where you had a comparative, basically starting from scratch, the invention of a new industry. This is a huge industry that already exists, and so changing even a small percentage of it will have an immense impact on the economy. So I think we're all excited to kind of be working in this space. Let me just say a couple words about NDN, the group which I work for, which is putting on this event. NDN is a Washington, D.C. based think tank which believes in market-oriented approaches to policy questions. And we're very fortunate to have with us extraordinary people in the audience. I want to particularly acknowledge Jim Hines, who's running for Congress in Connecticut. So hopefully many of you have already had a chance to. Jim, do you want to stand up? To talk to Jim, and if you haven't, we'll have a chance to talk with him at some point later on today. So without further ado, let me turn things over to Peter Fusaro, who's going to talk about clean technology.
Thank you, Michael. I've spent 33 years on energy and environmental issues. I worked as a policy analyst under the Ford, Carter, and Reagan administration at the Department of Energy, helped get the lead out of gasoline, worked on LNG safety and siting. Native New Yorker, worked with Mayor Koch's energy office on establishing some of the first energy efficiency programs in the country, called Enlightened Energy in the 80s. Worked with Toyota and the Prius 12 years ago. So I've been in the trenches forever, and it's a pleasure to see this market growing and the tent getting bigger. I have a very simple mantra: education breeds market liquidity. We have a number of well-defined websites with free content. All of my books, you can download the first chapter. The most recent has been Cut Carbon, Grow Profits, and that chapter is called The New Green Business Model. And so we're going to kind of drill down more on what's going on out there and why it's different this time. I get a lot of noise. This is the dot-coms. This is not the dot-coms. We're talking about transforming the world's largest business, energy, over $6 trillion, into a much more clean and green and efficient business. So we've got higher sustained energy prices, not just for oil at all-time highs, but natural gas and coal, which still fire the world economy. We've got better technologies and more rapid technology shift underway for both renewables and clean tech. And we have environment as the new market driver. As people on Wall Street like to say, this is the new alpha. So this is the best opportunity to transform not just the US economy, but the global economy. So why green now? People have been talking about this for decades. It really has fallen on a lot of deaf ears. People haven't made money. 25 years ago, we had wind turbines and solar collectors that have been abandoned. This has become significantly different because it's risen as a corporate financial issue. Banks now have a green screen, aka the TXU deal, where they couldn't build their 11 lignite plants. Consumers want green power. There are over 600 programs today where consumers can elect to pay more for clean energy. We have the Kyoto Protocol in 174 nations. We have the EU Emissions Trading Scheme in 27 nations. And finally, we have the United States moving forward on climate change. I don't think Mr. Bush's remarks today will be very significant, but whoever is the next president will move forward on cap and trade at the federal level. We invented market-based solutions. They came from Wall Street. They came from a gentleman named Lou Ranieri, vice chairman of Salomon Brothers, who took this to the Environmental Defense Fund, who took it to Bush 1, and basically took a financial instrument and applied it to air quality. It's worked. Our markets are 13 years old for acid rain. You don't hear so much about acid rain these days in the Northeast. You do hear about it in Northern California, however. And we've had a NOx oxide market since 1999. We need, however, a regulatory framework, a policy framework to create the financial certainty for investments. There is no incentive today to being clean and green if you get penalized for early action. We make markets in this country. We have 36 environmental financial markets, things you don't hear about from the media. The media is very focused on the EU, and they invented carbon in London last year. We have compliance-driven markets. You must look at compliance with a financial sanction for not complying with the law. So that's CO2 beginning here in the Northeast next year, and in California in 2012. It's sulfur dioxide, that's acid rain from coal-fired plants. Nitrous oxide, urban ozone from cars, trucks, and power stations. Renewable energy credits, mobile emissions reduction credits. Very important because we're going after mobile sources in California and 17 other states. Wetlands credits, preserving nature, as well as forestry. So we're going to see a market in the U.S. substantially different than Kyoto. We're 6 billion metric tons of CO2. That's our carbon footprint. And we're going to do everything it takes to reduce that carbon footprint. So that's going to be a lot more innovation, a lot more new technology, and a lot more efficiency. You have to remember, the U.S. economy was built on cheap energy due to abundant natural resources. We were blessed. It was a highly inefficient economy. That's going to change across multiple sectors. This building has a carbon footprint. The building owner probably has done nothing with that. He gets an energy audit with SO2, NOx, and carbon. That's going to change. So we've got efficiency across multiple sectors, buildings, transport, heavy industry, renewable non-carbon sources, wind, solar, geothermal, carbon-based renewables such as wood and biofuels, carbon sequestration where you capture the carbon and store it. And one application is to use that for enhanced oil recovery. In this country, we've drilled 510,000 oil wells. We're still the third largest producer of oil on the planet. So we do import a lot of oil, but there's a lot of found reserves that are going to do CO2 injection and carbon sequestration. And there will be many more innovations to come as this market matures. Now here's the bad news. Nothing has been done on climate change. We're burning more fossil fuels globally. It's up 3.1%, actually accelerating since the year 2000. So despite all the headline news, we've barely started. The United States is 22% of greenhouse. So pointing the finger at China points the finger back at us. We are the biggest emitters on the planet and may be eclipsed by China. There are many new technologies waiting for deployment. The key stumbling block is, what's the price of carbon? If the price doesn't exist on your pro forma, you're not going to see a lot of deployment of better technology. So on Wall Street, a lot of modeling puts a price of 0 at for carbon. On the Chicago Climate Exchange, it's $6 a ton, and that's a voluntary, not a compliance market. Many of us believe carbon prices in the U.S. will be $30 to $50 a ton. So where are we in U.S. carbon markets? We have AB 32. They're now implementing the protocols this year. As the protocols are implemented, markets begin. So forestry protocols were completed. We had 2 forestry swaps with PG&E as the buyer. Here in the Northeast, we have the Regional Greenhouse Gas Initiative, a very modest program, 10% cut by 2019, affects only electric utilities. The Midwestern governors have also enunciated a program, and the Western Climate Initiative, which is Western states including California, is looking at a 15% cut by 2020. So the states have been moving. It's pretty non-standardized today, and we've been waiting for Godot, and that's the federal government, and this time Godot is showing up. So we need, on a federal level, significant long-term greenhouse gas cuts of at least 25% by 2020, and that's the California model. Transparency via standardization. You need to understand what you're dealing with, and we do have an EPA that serializes SO2 allowances, so we need a regenerized EPA, not the EPA of the Bush administration, but an EPA with teeth, with enforcement. We need carbon offsets and derivatives. There's a lot of talk about being carbon neutral, but you've really got to do it with the proper credits. Linkages to international markets. Since this is a global problem of 27 billion tons and growing globally, we need to be able to harmonize with other trading regimes. And we need long-term solutions with compliance penalties. Not many folks are talking about that, but one reason the SO2 program for acid rain works is it's $2,300 a ton for noncompliance. We had 100% compliance until last fall when an East Kentucky coal utility burned more coal and paid a penalty. And no price caps, a really dumb idea that Jeff Bingaman has been talking about, $12 a ton. That distorts markets. We want to have economic pain that incents industry to do the right thing. So where we are on the carbon highway is the bottom of this highway. Most companies outside the energy industry have not inventoried their carbon footprint. The goal is to move up this to a low carbon economy. That's through commitments to both voluntary and mandatory reductions, implementation of energy efficiency and renewables, moving into international as well as regional trading schemes, and then moving up into the CDM world of the Clean Development Mechanism of global carbon reduction. We will be buying in the CDM world. The bigger picture is the clean energy investment opportunity is vast. We have underinvested in U.S. infrastructure to the tune of $1 trillion, and it gets worse every year. So a lot of buzz on solar and biofuels, but it's a bigger mandate. Distributed energy, combined heat and power, waste heat recovery, lighting systems. I did the World Trade Center's lighting systems 15 years ago. You can save a lot of money, and not just compact fluorescent bulbs. The next generation is LED lamps. So you've got opportunities through cross technologies from the medical and biotech establishment, from gasification technologies to information technologies, where Silicon Valley has been very focused. They haven't learned the metrics yet of the energy business. The energy business, as Enron used to say, is iron in the ground. You gotta build things. It's not IT-only solutions. There are some applications of demand response, net metering, energy management, but you gotta start building stuff, and that means project finance. So what's starting to occur is capital deployment in the initial stages. Here's the energy reality check. This is where the problem is. Cleantech, entire global investment last year was $5.18 billion. The U.S. private sector, that's all energy companies, be they oil and gas or utility companies, $4 billion. The federal government, $7.5 billion, mostly wired to ethanol plants and the dead end of FutureGen, which has been killed off. We're still going to be using gasoline 25 years from now. It's going to be plug-and-play hybrids. So you have to look at a national policy to scrap and retire inefficient vehicles. Unocal did this 20 years ago and got rid of 7,000 clunkers in Southern California. We have to move to plug-and-play and not the nonsense of biofuels. The next piece, water. We've got $1 trillion underinvestment in our water infrastructure. Here in New York City, you still have wooden water pipes. In London and Paris, 50% of the water has problems. So we have a crisis not only in energy, but in water. So clean tech is going to come faster when the rules are right. The market opportunity is immense. It's not just the United States, it's also global. You can leapfrog to cleaner technologies throughout the world and reduce greenhouse gases. The risk capital is available. The nonsense that we cannot afford this is not true. McKinsey numbers, the worldwide web of wealth, $140 trillion. U.S. wealth, $47.6 trillion. We have deep pools of capital that are waiting to be deployed, and mostly from the private equity side of the house, not clean tech venture, not from hedge funds, and they're waiting. What's missing is the lack of a U.S. carbon price signal. So where will this money come from? Well, venture typically has 10-year lockup, up to 10-year lockups. Hedge funds typically are traders, arbitrageurs, and private equity. But what's starting to occur in this new green business model is that we're funding projects with 1 to 4 year lockups and trading and monetizing these multiple streams of environmental credits, not just carbon, SO2, and NOx, but renewable energy, biofuels, even things like mobile credits. And the impact on investment is to reduce the cost of capital and increase the IRR. So this is going to create a lot more liquidity to markets, but also a lot of price volatility. So because this is more of a political event, I decided to put a couple of things in about politicians. What they know and what they don't know. Sound bites with no knowledge of the consequences. Biofuels has been a debacle. Its deleterious impact on global food markets, it's a failure. Should have just sent the farmers checks. I've been saying that for years. This is a very bad idea. No long-term energy and environmental policy. Why? Because we run our subsidies on election cycles of every 2 to 4 years. This is going to take time, folks. This is no quick fix. We're talking about changing an entire economy into a decarbonization process. Little knowledge of the capital markets. This is a $6 trillion business which runs on 20-year investment cycles. So how do you incent them? With the rule of law. And thank God we have a Supreme Court that ruled last April 2nd that CO2 is a pollutant, and shame on the EPA for being the defendant. So the idea behind all this is politically, you're going to create lots of jobs in green. I've placed 6 of my interns from Columbia University on Wall Street. There's a dearth of intellectual capital in this sector, and there's a lot of opportunity. So, as Winston Churchill said, this is the end of the beginning, top of the first inning. The problem has been identified. Climate change is real, tangible, and must be addressed. It's engineering and technology solutions. Trading is a facilitator to clean tech. It's not the be and end-all solution. We need a greater deployment of knowledge in this sector. This morning I met with a group that's going to launch a carbon portal that will be free. We need to educate many people. Education will bring liquidity. We've underinvested for decades. As H. Rap Brown said, the chickens have come home to roost. The problems in air travel, blackouts, water quality are because we've neglected our infrastructure. It's not a sexy topic, but it's very fundamental to how we run the U.S. economy and how much waste is being lost in inefficiency and healthcare costs on top of that. So we don't need new government programs. We need government policy framework for greenhouse that works. As I said, long-term, significant cuts, no price cap, and an EPA with teeth. Thank you very much.
Thank you very much, Peter, for that kind of stirring discussion of the subject. And now, David, perhaps we'd like to hear from you about a little bit more about the clean technology opportunities. Thank you.
Good afternoon. Thank you for coming by. My name is David Kurzman, and I am Senior Vice President with Panel Intelligence here in New York City. First of all, you'll notice whenever Peter talks, I take a lot of notes. It's kind of like school is in session. If you ever get a chance to hear Peter speak, if you get a chance to download some of his books, do it. He's one of the brighter minds in this space. Surprisingly, you'll notice we have a lot of the similar ideas, and yet we did not collaborate on our talks. So let's understand a little bit about this clean tech opportunity, and let me provide you a little bit of background as well on myself. I have 12 years on Wall Street, 6 of which were in the clean tech sector, actually 7 now. Going back in January 2nd, 2000, I was hired to start the alternative energy and industrial technology, before clean tech as a term was coined, for H.C. Wainwright and Company. Then I worked for Needham and Company for a couple of years, running their clean technology research group, and then launched my own clean technology hedge fund, which I ran for about 4 years before joining Panel Intelligence. The problem here is that I only have 20 minutes, not 2 hours, because that's what this topic really deserves. And this is another problem, that we still look for other opportunities as a way to make money in clean tech. Hopefully everyone can see that. I'll read the caption. This is our most successful project, pointing to the wind turbine. When we dug the footing for the wind turbine, we struck oil. Here's another problem that we have. The wind turbine has other unappreciated issues. A lot of folks say it kills birds or it destroys your skyline. So let's just back up for 1 second and define what clean tech is. It's any technology or service that reduces humans' impact on the environment. Now, this covers, as Peter really pointed out, a plethora of areas. Peter really focused mostly on that center column, what I'll call the alternative energy sector. But really, it's a small piece of a whole bunch of larger industrial sectors. It's flow control, filtration technologies, catalysts, manufacturing industrial processes, agriculture, and nutrition. The idea here is to really try to understand clean tech, you've got to be an expert, a little bit of an expert in a whole bunch of different things. Well, how big is this? It is enormous by any definition. And this is just a handful of some of the subsectors, where we were in 2000 versus where we expect to be in 2015. The problem is, again, how do you deploy large amounts of capital into an area that is so young and at the same time is very, very early stage? I'll get a little bit more into that. And it's growing at astronomical rates. What is the trend? And Peter began to address this. Does this group have staying power? I believe it does. But let's just take a look at some of the facts. Back in the 1970s and 80s, we had what was largely a regulatory-driven market. There's nothing inherently wrong with that if it's done right. As Peter said, if the policy has teeth. We had compliance-based purchasing and end-of-pipe technologies, such as scrubbers and other filtration technologies on our coal-fired power plants. We had relatively slow growth markets, as well as some what should be phrased as questionably sustainable fringe businesses like solar, where the economics were not yet there and there sure wasn't the policy behind it. We also had a plethora of inexperienced managers. But where are we today, knowing where we came from in our history? Well, science really has caught up with awareness. The bleeding heart liberals, they were right. They were right, but we just didn't have the science ready to really address the problem. Global warming, our pollution issues really do have an economic cost. So we have now these economic market drivers, as well as a growing awareness, not only here in the US. We're always the last to learn. We were the last with seatbelts, we were the last with anti-lock brakes. I mean, it's no great surprise to me that we're going to be last to the party in clean tech. Furthermore, on the economic drivers, this is also a part of understanding where some of the regulatory opportunities are. We have a real focus on trying to maximize profitability, because if you think efficiency and productivity will go out of style, then you really shouldn't be thinking about clean tech, because they never go out of style. No business person in his or her right mind wakes up and says, you know, I think I want to make less money today. They want to make their business more efficient each and every day. The process technologies, trying to reach zero-emission plants. Again, that feeds right back into the profit maximizing and efficiency question. You have incredibly fast-growing billion-dollar markets, as I've already suggested, as well as what Peter has termed, that was actually his term that I stole from him, corporate green screens. He took it from one perspective. Well, the investments banks have a green screen. Well, so does Walmart. So do a lot of different retail and commercial businesses. And there are now whole new business models that didn't exist, like demand response. I will pay you every quarter if you agree to shut down your business for several hours when peak power demands are causing instability on our electrical grid. That business model did not exist in its current form 10 years ago. Furthermore, and this is perhaps the most important thing, we have an incredible pool of talent that is being attracted to this group. When a business manager gets acquired by Philips, says, thank you, I'm going to take my golden parachute, and then goes and starts up another company, and he sold the business for over $1 billion, he doesn't have to work anymore. Why does he go and do that, continue doing this? It might be for, to feel good about himself. Maybe it's because his children are going to be inheriting the environment that we leave them. But the bottom line is they're all attracted to these different bullet points right above. So if you're going to come away with one sense here, it's definitely going to be to watch where the money flows. And Peter's right. The certainty in the financial markets, long-term certainty, is what drives the financial opportunities. So the first inning is over. It's kind of funny that you termed it that way, Peter, because really that's all we've gotten through so far. We've invested cumulatively over $15 billion into clean tech just since 1999, roughly 10 years. And that is only a drop in the bucket of what's needed. We have billions and billions that private equity and venture capital still need to put to work. And they don't get paid if it doesn't get put to work. So where is that money gone? Well, Peter's right to focus on alternative energy because almost half of it has gone to energy-related opportunities. The next big one is, looks like their environmental IT and what's considered enabling technologies. Transport and logistics, that can include the fact that FedEx and UPS now, they count how many times they have to turn left, because every left turn means that they have to then idle and cross traffic. And that costs them not only time and fuel, but eventually money at the end. So understand what you're watching. This is going to be key to understanding how to identify these market trends. For instance, where has this money gone from a financial perspective? What does that teach you? Because a lot of this money can be put to work in big chunks in project finance. But is that necessarily where Main Street or Wall Street or foreign investors want to put their money? Well, bottom line is private equity for projects, project finance, the yellow bars here, is where the large magnitude of money has gone, while this private equity for companies, by its very nature, is going to be much bigger than venture capital, but has received a surprising amount of money. Fortunately or unfortunately, a lot of money back in the first half of this decade, and very true in 2006 and 2007, went into pipes, private investments in public entities, which basically means that we were funding a bunch of public companies at private equity valuations. So policies and regulations. Well, today's New York Times has an article, and I've clipped a section of it, that we're taking a look at trying to extend the investment tax credit, the ITC. So follow the money. It's a very timely subject. If Senator Cantwell from Washington has her way, she's going to extend the ITC, which is a $6 billion 10-year proposal, to make sure that renewable technologies have the funding. If that doesn't get renewed, those projects are very likely to die on the vine. I happen to think it's not a if, but a when, but I'll get to that. So I don't have eyes that can read that either, so don't worry. The idea here, the point of this slide is this is just the current legislation in our 110th Congress of what to be watching. You can go to bradleywoods.com. This is all available for free on the web. Education really is going to increase this opportunity. And so there are a lot of different things you can be watching. I know I can't watch every single one of these, but these are all in Congress, and I'm sure I probably missed one or two. So you got to understand, as my father has always said, where you've come from to make sure you don't repeat your history. So I highly recommend that we recognize that 2 years ago, we were dealing with what I called public venture capital. So in other words, these were companies that really had no business being public, and yet there they were receiving large amounts of capital, largely due to the fact that there was more excitement than there was substance. So at that time, I recommended that Cleantech managers use that opportunity to increase their coffers, AKA call your banker. Since then, valuations have moderated largely across the sector pretty well. A year and a half ago, they finally did moderate, and they did call their bankers. But not before a lot of companies had their IPOs and their merger and acquisition transactions. And I put a couple examples up here: Veriston, Aventine Terrace, North Island Green Energy, et cetera. The point is that with that capital, they can now execute on their business plan. So what is the lesson? Follow the smart money. Because if they're running for the door, take note. You might want to do the same. A year ago, I said that investments in the renewable space were experiencing what I called an incentives-led boom. So solar and ethanol investments were where you wanted to be. And that largely played out as expected. I also said at that time you should begin to watch for the end of the silicon shortage sometime in 2008. I was actually thinking it would be the second half of this year, but it's now over. In fact, it was at your conference, Peter, several weeks ago that I first came out and I said, it is over. We're starting to see cancellations of orders. When a company says, wow, I don't like the fact that my silicon supplier in China is dumping the old chemicals into the rivers that are killing people downstream, so we're going to cancel our order with that polysilicon supplier, that's a sign, because I guarantee you, if there were still a shortage, there would have been no mention. They would have taken that polysilicon left, right, and center at any price. So 6 months ago, I was talking about how hydrogen as a fuel was beginning to become the hot topic again. Well, here's the problem. Hydrogen is an industrial gas. It's not a fuel. It's not a panacea for our problems with fossil fuels or global warming. It is a very well understood commodity. Furthermore, hydrogen from renewable sources, have your solar panel or your wind turbine to generate your hydrogen either through electrolysis or some other way, that is a niche opportunity at best. Again, not a panacea. Where folks should be looking 6 months ago, and I think this is true again today, is in battery technology, specifically on the cathode and the separator. There's some work going on in tin anodes, but the bottom line is it's inside the battery, not the battery itself, the packaging and so forth, where the magic is. I also said 6 months ago that the corporations were employing a green screen, which gave a lot of vendors and suppliers an opportunity to benefit. Furthermore, carbon capture and sequestration of carbon dioxide was going to be potentially one of the biggest opportunities as part of the clean tech market that we've ever experienced. But it would be best addressed by financial markets and certain select technologies. But this is going to take a long time to develop. So where are we today, and what should we be looking for in the future? Again, I think the renewal of the ITC, the investment tax credit for renewable technologies, is a when, not an if. And the reason is this is an election year. Politicians love to look green, so they're going to posture and they're going to look as green as they can. They're going to probably wait till right up before the election. Earth Day is going to come and go on, what is it, April 22nd. Maybe somebody will try to get something passed. It won't. Very likely is that we're going to see this sometime in the second half of this year. Furthermore, the rebound in solar stocks is currently underway. It's not over yet. So look for the biggest and the cheapest among those, and also look for the companies that have catalysts. So they might have a subsidiary that they need to IPO. So the drivers here are, if you are if you are a photovoltaic manufacturer or solar manufacturer, the end of the silicon shortage means your highest cost raw material is about to decline in price. That means your margins are likely to expand. Likely renewal of the investment tax credit, another driver. Earnings and revenue increases. This is an industry that's growing 30, 40% top line revenue per year. And estimates are probably going to have to go up. IPOs of subsidiaries, and as well as further expansion of state renewable portfolio standards. In other words, states such as New York have mandated that by 2020 or some other arbitrary date, way down the road, a set amount of our electricity has to come from renewable sources. There are problems with these laws. For instance, what if they have no teeth? Where's the compliance issue? What if we don't meet it? Who gets punished and how much? But the idea here is that that will serve, at least in investors' minds, as a catalyst. Again, always follow the money. Watch for the exits by the smart money, because that'll be a sign that the end is near. With the silicon shortage over, prepayments on the decline, and plant construction, we just saw, I believe it was STP, or no, it was Trina Solar, just canceled a $1 billion polysilicon plant that they were going to construct. They canceled that earlier this week. So then the question comes, is a bust cycle following the boom cycle likely to happen? And I think it probably is. So this could be a big boon for photovoltaic manufacturers' margins. The path to sub $1 per watt production costs on solar cells is very clear. We're almost there. In fact, cadmium telluride photovoltaics are probably going to be the first one there, very likely followed by copper indium gallium diselenide, or CIGS for short, technology. Probably. And the reason I say probably is because there are some technology hurdles that need to be overcome. Companies with the greatest growth margins, profit margins, are going to be the most likely to win. But don't overpay for growth, because eventually that whole industry will commoditize. Hybrid electric vehicles and plug-in hybrid electrics, opportunity is enormous, but it is very, very difficult because there are so few public investments to play in that area. So you have to be very selective, look to private companies, look to valuation, and again, watch for the exits. Ethanol, to quote the teenagers, is so last year. Now it's an asset play for the private buyers. They're going to go out and say, well, in the public markets, we're not going to get the valuation we want, so it'd be better to have the cash flow. So they'll buy the plants. Carbon could arguably become bigger than oil and natural gas combined. The carbon markets and related technologies are potentially the largest opportunity within all of clean tech. And they're best addressed by the financial markets, as well as certain select technologies like carbon capture and sequestration. This could take decades to implement, though. And the reason is, even after public policy is created, even after we have our election, even after our new president selects his or her first 100 or 1,000 appointments that have to be Senate confirmed, we still then have to give corporations enough lead time to prepare their business models and adjust. So this could take a long time to put into place. And again, another problem here, very few ways for Main Street to play in this space so far, but that's likely to change. I do think mercury abatement and related technologies, and there are some public companies in this space, if you do a Google search for activated carbon, companies, and mercury, you'll see a whole bunch of different companies that you can invest into this space. And activated carbon is the cheapest way to get mercury, almost all of it, about 95% of the mercury out. It's much better that we get it out in the activated carbon than to have it in the fish that, and water that you and I consume. Our water and electrical infrastructure, Peter said it, it's grossly underinvested, and regulations are tightening. So emergence of whole new business models like demand response and the constant need for clean water and sustainable electricity are the way to go. Meanwhile, capital continues to pour into VC and private equity funds. They have to put that money to work to get their 1 or 2% and to earn the 20% upside that they earn. They're competing against hedge funds for ideas. That's a real problem, and I can speak to that. Having run a hedge fund, I made 6 private equity and venture capital investments. Now, I was fortunate. All of them worked out or broke even. But a lot of the hedge funds out there are grossly overpaying because they don't understand what they're dealing with here. So that flow of capital and those public market valuations that they're going to put on private companies are only going to eventually be pushed back into the public market, and multiples will expand into the stratosphere. Follow the smart money. I can't say it enough. The smart money today is investing in solar, mercury, gasification technology. So instead of combusting coal, you basically gasify it. You boil it. You gasify waste. And the good side of that is it's potentially lower pollution and a lot more efficient. Digestion technologies. You take organic matter, you can anaerobically or aerobically digest it and create natural gas and fertilizer, as well as big investments in infrastructure. And by the way, in the infrastructure area, I think there's going to be a whole new market created in infrastructure-related bonds and project finance bonds. And the idea there is the folks who are lending the money are going to want to securitize those. It's a very well understood business model. Then turn around and sell those securitized cash flow streams to other investors like hedge funds. A lot safer to be than subprime these days. Thank you very much.
Thank you, David, and thank you, Peter. Those were both very interesting presentations. So I think we're likely to have some questions for panelists. One thing that struck me in both of your presentations is that we have a situation where there's some great technologies out there, there's some great opportunities for savings, but a lot of these things are dependent on driving down costs, which is dependent in turn on volume. And I know, for example, that the power generation business is $1 trillion business. Some of the renewable portfolio standards call for 25% of that to be in renewables, which creates a $250 billion market. But at the same time, people say that the power companies, the utilities, are some of the kind of most traditional, old-fashioned customers you're likely to find. How do we scale these technologies? How do we get them adopted? Will ultimately this consist of the utilities buying new technologies, or is there an opportunity to kind of create more distributed markets that might conceivably drive the whole process faster? Would anyone care to comment?
All of the above.
Okay.
Yeah. Utilities don't really put money into R&D. And I work with a lot of utilities, so they're going to be buying the technology. Secondly, by setting the RPS, Renewable Portfolio Standard, you're incenting them to go out and source materials. So California is 20% renewable purchasing by 2010, the most aggressive in the country. Also, the other piece of this that has to come about is what's called decoupling. In California, utilities can sell energy efficiency. In other words, a utility normally wants to sell more electricity because they get revenue for that. But in California, they've allowed utilities to sell efficiency. We need to do that nationally.
Right. And we were talking about the fact earlier that renewable portfolio standards have gotten over 50 votes in the Senate to become national law. What are your thoughts on that? Is that likely to happen? Are we likely to see federal legislation on that?
It's the same problem as greenhouse. We need 60 votes in the Senate. The Southeast, all the states don't have an RPS. So if you don't get 60 votes in the Senate, we're not going to get a national RPS. It's the way to go. We have 25 different markets in the U.S. on renewables. It doesn't make a lot of sense.
The other point here is that when was the last time you saw a utility have a breakthrough technology? So they're not going to be the innovator. They've got to look to other folks. And that's why companies like Chevron Texaco and Avista and so forth, they all have their venture capital groups. So they are putting money into this in another way. The second point here is that, and this gets back to the decoupling idea, if we create this right through policy and regulation, we're going to be able to allow for electricity to have two values: the value of the electrons and the value of the cleanliness of how you generated them. And by being able to split those up, the financial markets are very good at not only valuing those cash flow streams, but securitizing them, putting them into products, making derivatives out of them. A quick third point is that the renewable portfolio standards are creating a whole new market for something called renewable energy certificates, or RECs for short. And RECs are allowing for the resale in other markets. For instance, in my apartment here in New York City, I purchase wind power. Well, how is that possible? We don't have any wind turbines exactly nearby. Well, it's because I say to Con Ed that I want to pay a little extra, and they have to go out and buy the wind turbine credits, the RECs, from somebody who is producing it.
And I think it's very exciting that we are seeing the costs come down on these technologies. Particularly, you mentioned in your slide there's a path to under a buck.
Correct. Production cost.
In the case of solar, and the improvement in the silicon availability should help that. Well, why don't we open it up now to questions from the floor? Yes, please.
Hi, this is a question for both Peter and David. In both your talks, you seem very optimistic as to where the trends policy-wise were heading and what the future looked like for green energy. But to me, it looks like we're starting to get to the point a bit where people are being forced to dig into their pockets to comply with some of these schemes. And there's a lot of pushback. Things I could think of include the fact that credits were mispriced in the first stage of the EU emissions trading scheme, and they look like they might not be priced properly again. I know Alberta is talking about how they're going to price carbon credits there and impose those costs on oil sands producers, and they're pricing them, I think, something like $15 a ton, which is not going to cause any reduction in emissions there.
Right.
Thinking about the fact that demand response providers are still having to fight PUCs to get this solution implemented properly, and a lot of electricity markets aren't deregulated. I'm thinking about the fact that Cape Wind still hasn't gone off, and it seems like every argument in the world has been thrown out there. I personally would like to be very optimistic about these initiatives going forward, but it seems like what's happening is in the China's not going to decide to cut emissions if we don't decide to. There's no real basically drive to actually get this stuff down. It's a lot of posturing, it looks like.
Okay, let's do it one by one. We're not the EU, and they learned from their mistake of over-allocating allowances. We're not the Canadians, which are trying to do a lot of different things, including sourcing emissions. We're the US, okay? Secondly, we have an infrastructure crisis that's not going away, and industry is waiting for the rules. You have 30 corporations with 6 NGOs asking for mandatory standards for carbon dioxide. You've got industry in the forefront, financial institutions as well as big corporates that are demanding regulation. So I disagree that we're too optimistic. No, we wasted so much time doing nothing in the last 8 years that you've got pent-up demand to deploy capital. Major corporations are not going to deploy capital without getting the rules right.
Yeah.
If I could comment on the EU situation, we just came out of the training phase for the EU. So the EU has taken a real hit in terms of having had some trouble getting their act together. But it was contemplated from the outset that to set up a system this large would take a few years for training. So they only entered the post-training phase at the beginning of the year, and they are getting the kinks out of their system. So I think going forward, we're likely to be able to learn from their experience.
Absolutely. I mean, remember, we created cap and trade back down in Rio in, what was that, 92?
No, we created cap and trade on the Clean Air Act amendments, 1990.
90.
The EU learned from us. Don't get it backwards.
Yeah,
they learned from us.
We
know how to do it.
The other point here is financial markets need certainty. And without it, they don't know how to build their business models. And that certainty needs to be multi-year, preferably decades long, 2050 kind of numbers. And so in terms of what certainty is coming down the pike, all 3 presidential candidates are somehow pro-green, probably cap and trade, and as soon as we get past that hurdle, you know what's going to happen. Whomever is in office, probably a Democrat at this point, the way things are leaning, is going to say, right, here are my first 3 initiatives. The war, education or healthcare, one of the 2, and something green. Well, you can't do anything about the first 2, because that's just a non-starter in Congress. So they're probably going to focus on green. So my whole thought here is it will take time, as I said in the speech, but I do feel like we have, if you look down the road, at least 9 months, we do have a certain level of certainty coming down the pike.
I think your point is a very good one, however, that the lack of clarity and consistency on things like the ITC, both in the year 2000 and 2004, when that credit was allowed to lapse, there was a complete drop-off in wind production. And because of the lead time involved in putting up turbines, we're seeing a similar thing happening this year. So we do need the kind of consistency we'd get from an 8-year, for example, credit.
What does worry me, though, is people say the real competitor to the all-electric car is the hybrid. Aren't we just going to drive more miles, et cetera? No. The competitor to the electric car is Tata Motors out of India, who wants to make a $2,000, $3,000, $4,000 car that's also going to consume tons and tons of fuel and be able to be priced so far below hybrids that you can't drive enough miles to make up the savings.
And it won't be a Jaguar, which Tata just recently acquired. Other questions? Yes, please.
I've heard someone describe, and I think I partially agree, that if you look at the pyramid of energy sources that will be necessary, starting at the bottom are big, simple things like wind and solar thermal, and at the top are kind of more esoteric things like algae or whatever you want to come up with. If you look at the funding, it's the opposite. The money goes to those esoteric silver bullet kind of situations that people believe will solve the problem in one fell swoop, rather than big implementation issues. And I worry sometimes that clean tech is not so much a misnomer, but it's misleading us from the main work, which is just simple nuts and bolts, pig iron implementation of building out these wind farms and building out these solar thermal farms. How did that shift get made? Is part of that going into having the private equity firms look at this more like project finance than high-tech venture, or how do we make that transition away from imagine?
You show them the profit margins.
It is project finance. And it's going to have the paybacks of project finance. It's not going to be the 5 and 10x everybody's expecting. The reality is we still have a small build-out on wind and thermal solar. Now they're scaling, they're bigger, and they're mature. But realistically, we're still burning a lot of coal, 1,500 power stations. We're burning a lot of natural gas and a little bit of oil. So you have to look at this shift is going to take a while. That's why you got to look at the other side of the equation. The capital intensive is gasification of coal, carbon capture and storage, the real issues, which not too many folks want to start deploying billions of dollars, not millions as the VCs do. It's just starting. Now, we did a report for the National Energy Technology Lab 4 years ago on gasification of coal, rapid deployment. There were 0 projects. Now we've got 25. So at least there's some movement there.
The other point to be made is that look at the quality of the investor. We had a lot of money that got unlocked from .boom, .com, .bust. We had a lot of money out of biotech, and they brought those similar mentalities to Cleantech, hoping to make the 5, 10x return. They're going to be grossly disappointed. Now, here is where, when you see the folks that are really good at, project finance type of returns and putting the leverage on the Macquaries of the world, the private large hedge funds, when that money frees up and that starts coming in, then you know that the financial certainty has been created and it's attracting the right kind of investors, and they know, like Carlyle Group, they started out in Washington with military. They're going to then turn around to their congresspeople and say, hey, let's make this happen. So.
Yes.
I wanted to ask the question, whether it's a Republican or a Democrat who comes in. I mean, we all know what we want in this room. Both of y'all made a discussion that talked about the private equity piece as well as the public piece. Putting on your future thinking cap and the fact that you've worked for every president.
That's a nice way.
Really trying to understand is, where do you think the public will, where do you think Department of Energy and Labor and all the other agencies are going to go on the clean tech, and where do you see the private sector?
Well, first of all, I think it's totally bipartisan. It's 60 votes in the Senate. It's the magic number. Whoever, plus, because this is such an urgent matter, it's not day one, but by early 2010, possibly late 2009, we'll have federal legislation. But then you got to implement the legislation. And I used to be a reg writer also, so you're going to have to fast track that, hopefully for 2012. So the reality is, once those rules are there, then you have the compliance and the implementation. Then you're going to unleash the capital. Not right now. This is all diddling around where we'll try some things out. That's going to deploy the private equity. I've talked at a Dow Jones private equity conference about 2 months ago, about 400 private equity funds in New York City. They were interested in oil and gas drilling. They were not interested in green. They're confused with all this political and policy dimension. But the reality is, there is consensus. The science is done. It's ugly. The climatologists, the epidemiologists, all that is done. The real issue is we've done nothing. The world has done nothing. And the world better do something in the next 10 to 15 years, or it's lights out.
And I might just say that although the private equity and the hedge fund money doesn't seem to have stepped up to the plate yet, this is currently the 3rd largest investment category in Silicon Valley after life sciences and IT. So there's a lot of money pouring into it on the VC side. And then if you look at the possibility of carbon credits, that's a $1 trillion market in London. So that could be coming down the pike as well. Yes, Jim.
If you price carbon, as everybody says we must do, or bring online alternatives faster than they would through regulation, what is the retail impact on the consumer? How much more does a gallon of gas cost, or a mile driven, or their utility?
Well, this is what they don't want to talk about on Capitol Hill. It's going to cost for everything. Last year I briefed the air carriers. They argued, well, we're $30 billion in debt. It's going to be in your airline ticket. It's going to be in your gasoline price. It's going to be in your car price. It's going to be in your utility bill. And I'm talking about bumps of perhaps 40 to 50%. No politician wants to tell consumers it's going to cost money for a cleaner environment. And that's the reality. And that's what we're really talking about. And that's what's going on the debate. It's 10% cut or a 25% cut. That's what is on the table on Capitol Hill. And if we don't do 25%, we're never going to get there. It's useless. Because if you do modest reductions, because don't forget, every year we wait, the cost rises. And we have a healthcare crisis which directly circles around to global warming. Go to Dr. Paul Epstein at harvardmedicalcollege.edu. You want to see epidemiological evidence, asthmas, cancers, infectious disease, it's there.
The other, I just quickly want to touch here, if you take a look at the tens of billions, I want to say, we spend every month in the war in Iraq, how much did we spend in federal alternative energy last year? Single-digit billions? So single-digit billions for a year versus tens of billions per month. There's a real opportunity there.
But if it's 40%, let's go home. Ain't gonna happen. I mean, you know, if you're a middle-class family in this country right now, you're paying more for healthcare, you're paying more in taxes, you're paying more in property taxes, you're paying more in utilities. It's just
to put it in perspective,
then it's not going to happen.
A 40
Yes
buck a metric ton tax on carbon translates to about 15 cents a gallon. That's a huge amount of money, but on the other hand, look at what's happened to gas prices already. But I think you hit on a critical point, which is the technologies have to be invented to deal with this, because otherwise we are looking at unsustainable price increases. So the technology is key.
Jim, there's a key factor here. No matter what, the consumer's going to pay. Okay, that's a reality we have to accept. The question is, how are they going to pay? If we auction off these carbon credits, they're just going to be passed through in the form of price increases immediately, because the refiners or the utilities or whatever have to jack it up. They had to buy these credits. What's more likely, hopefully, is that they will be allocated. We have the business model that works. It's called the SOX and NOx, the SOX and NOx trading markets. So we have a business model that works. I don't really understand why.
It's not going to be allocated. It's going to be auctioned. Treasury wants a grab on money. It's 100% auctioning most of states in Reggie, and California and the EU have learned, hey, we can get money, forcing folks to go into the auction. So you're wrong. It's going to be auctions.
So that is potentially some bad news, because we're going to.
But an auction is tougher in terms of reducing emissions, because the price impact is starker. But you're right. You're absolutely right. Dealing with this is going to be very, not an easy walk in the park. Absolutely.
It's inflationary.
Yes.
In terms of the policy framework that you need to make all this happen, is it all at the federal level, or is there a state and local component that comes into play?
Well, 27 states have already moved.
Right.
The reality now is to harmonize this. Now, I've been in the trenches for 18 years on this issue. The reality is we actually are going to get some harmonization. It's called ISO 14000. And it's coming from ANSI, which is the standards board. So we're going to have to harmonize California and the West, the Midwest, the Northeast, and the federal program. But we're going to have a federal program. No politician is going to tell them it's going to cost money. But the reality is it's going to be a carbon tax through cap and trade. It's not going to be a real tax. It's just going to have the impact of a tax on everything you do, because we use carbon in ways you don't even think about it. Building this building, not just fueling it.
On the other hand, California has half the emissions of the rest of the country, so there is a tremendous amount that could be done on the efficiency side.
Per capita.
Per capita,
Per
yes.
capita.
What is the outlook for getting India, China, developing countries to participate in this type of plan? Because if they don't participate, it doesn't matter.
Yeah, but the U.S. position under this administration has been, well, China is now 2 coal plants a week and going to eclipse us in emissions, and they ought to move. Well, they're not going to move until we move. And don't forget one thing, and David already mentioned, the greenest thing that happened in this country was Walmart. 68,000 suppliers. Well, guess where they source from? China. China has $264 billion in its renewable energy program to be deployed now. They get it. They have problems of industrialization. But don't forget, there's an obligation of the OECD, because we put most of the carbon up there, to do the tech transfer, and that's the idea behind the international scheme of Kyoto of emissions trading. We're going to pay them not to pollute. There's been a bottleneck with the Clean Development Mechanism Board. They've been starting to disallow projects. It's ridiculous. A metric ton of CO2 equivalent reduced anywhere in the world benefits everybody. And that's got to be the attitude. It's not pointing the finger. Obviously, China and India are important players in this market, but the U.S. has abdicated responsibility and leadership.
The consumer awareness pushes the Walmarts push it into the business model of the suppliers push it into other countries. There's a clear path. It's the bravery to do it that is the next step.
And it has to come from the developed countries. We can't expect China and India to move out ahead of us when their standards of living are so far behind ours. Yes?
I mean, to me, the question is, what percent of our GDP does it cost us to do this, and now how evenly can we spread it? It's not going to cost 40% of the GDP, therefore the consumer shouldn't bear a 40% increase.
It's not going to be a 40% increase. I was talking about up to a 40% increase in electricity costs. You have to look at the metrics. In 1980, 6% of our GDP was energy. It's not 6% anymore. I don't see people stopping driving their cars with $4 gasoline. I was just in California last week. So we can afford this. This idiocy that we can't afford it, and the point is no one wants to say it's going to cost something to clean up the environment. That's the problem on Capitol Hill. No one wants to say there is a cost to doing this. It's not an onerous cost, but it is a cost.
When you fight a war, it comes out of the Treasury. Everybody pays evenly for it.
Yeah,
well, it's an enormous effort, but it all comes very evenly out of the economy.
So
they're talking about trying, these approaches. I'm worried. Direct it specifically to the consumer in a way that it becomes unpalatable for any politician to pass, and therefore it's hard to move forward.
I
don't think it'll be unpalatable.
Yeah,
I think they're going to have
consensus.
to act. The political pressure is really coming together, and they almost passed. They almost got the 60 votes on climate change this year. They're very close.
We're going to get legislation. Lieberman Warner comes out in June. Dingell Boucher comes out by the end of the year. This is not the legislation we're going to pass. It's going to be more stringent. That's why Bush is having his statement today. It's not going anywhere. The reality is the next president will craft legislation, and they all know significant cuts have to be on the table. And the argument we can't afford it has to go out the window. Because if we can afford this horrible war and waste $3 trillion on it, we can afford to do this.
Other questions?
Here's a question over there.
Oh, yes, yeah.
Kind of on the extension of those two things, so as you look at the three candidates, I mean, it sounds like at one level we have sort of, we know what the policy path is, but you need somebody that can sell this through. I mean, there's a marketing problem. Who of the three, who do you like the best? Who do you think has the best chance of being able to do the combination of marketing and
the different questions in there, because McCain has been the most proactive with Lieberman in the legislation. I actually personally think Obama will probably be more effective and Hillary probably least effective. But the reality is this has to be bipartisan. No one's going to have 60 votes anyway. And it's really Congressman Dingell you have to watch. Congressman Dingell, 53 years on the House, runs the Energy Committee, basically protects the auto industry. And it's Dingell and Boucher. Boucher's from West Virginia. That's a coal-producing state. We got to get some kind of clarity here. And he is a great parliamentarian. Don't underestimate John Dingell. And he put up the straw man of a $50 carbon tax. He knew that wasn't going anywhere. So realistically, it's all going to go to committee. This year doesn't really count. And starts January 20th next year.
But it really is something that all three candidates, McCain, Clinton, and Obama, support climate change legislation. So, and both of the Democratic candidates, Obama and Clinton, have $150 billion basically energy spending components of their economic package. I was talking to a former Assistant Secretary of Energy recently about how you would even go about spending $150 billion.
They'll find a way.
But there's a recognition that money has to be spent on the basic R&D in order to create the technology breakthroughs. And actually that's something that the U.S. is good at historically. We also have a great innovation system that hopefully can turn some of that into good technologies. But I think as Peter, you mentioned, this is a case where the U.S. has not been leading for some time. Basically, Europe is leading. We are following.
Europe is not that far ahead. They've basically been cheating and buying in the developing world the CDM credits. Realistically, the European market began January 1st of this year. The reality is we're not that far behind, and they're not that far ahead. I just came back from Copenhagen at a Point Carbon event, which is a big developer of carbon. We can catch up, and I think we're going to surpass them very quickly. And what's on the table in Europe, EU Phase 3, is 20% cut from 2013 on, 30% cut if the U.S. joins. And we're going to join. But really, it's 2 years away in re-engagement on basically the Kyoto Protocol 2.
Other questions? I'd like to ask our panelists, I think, one final question. If there's one thing that each of you could choose that would really unlock this economic opportunity and address the environmental challenges over the next 18 months, what would it be?
Well, my own opinion is that what started last month was the Green Exchange in New York with the banks and the energy companies and the hedge funds, and that's going to give us price discovery for carbon, which is very important.
I think we need a lot more certainty, and that comes from an appropriate level of discipline and in creating regulation and legislation. I don't have a specific one answer. Mm-hmm. I think it has to start from high up, from people who have the wherewithal and the bravery to put this forward.
Okay, well, thank you very much, everybody. I'd like to thank you, our panelists.
Thank you.
I would just like to mention that on May 5th, NDN will be hosting Rob Shapiro to talk about his new book, Futurecast, here in New York City. So you will be hopefully receiving invitations on that. And once again, thank you all for joining us today, and we look forward to seeing you again soon at an NDN event. Thank you.